Morning. I hope you're all doing well. This is going to be a quick video on the S&P cash. I was asked recently why I changed my outlook on the S&P cash for new all-time highs. Originally, my thought process was that we would trade somewhere in a range of about 55, let's say 54 to about 6,000, and then we would be looking to be pushing above 6,000 probably towards the back end of the year, Q4. Maybe new all-time highs happen around then, or even going into Q1 of 26. So the question is, what changed? So the reality is that there were a couple of things that most people, myself included, missed, and I want to just discuss it quickly, and then also touch upon S&P futures, because was also asked about that in terms of the COT report and positioning, etc. So what changed? Usually the way it used to work years ago, let's just say prior to COVID, markets that had some kind of extreme move to the downside usually had some kind of retest or constructive retest after a bounce, and then it would go to show that that low is secure. However, in a post-COVID market environment, that is no longer the case. What do I mean by that? With the advent of passive investing and the advent of more non-professionals being involved with the market, or more retail flow being in the market than it has ever been, the old rules that used to apply don't necessarily work anymore, or don't work the way that they used to work. Because of that reason, you need to adapt, and you need to adapt quickly. You can take stabs anticipating certain things, but if they don't work out quickly, you got to get out of the way. Let's use GameStop as a perfect example. GameStop was the herd mentality. There was not a person in the world who was a professional, sophisticated investor that thought that the move in GameStop was sustainable. What changed and what was hurting everybody was that there was a herd mentality of non-professionals or retail flows, whether it be through stocks or through the stock or options, that were pushing GameStop up. And it kept going to extreme levels. Why? Because there was a lot behind it. You kind of have that same situation now. However, it's a little different because it's not extreme. With the advent of index funds and passive investing, a lot of the old style ways of making money in the market are not necessarily working like they used to. What do I mean by that? The stock picking mutual funds, or not even mutual funds, the stock picking funds, they were underperforming the market. The more value guys, they were underperforming the market. Usually the way it used to work was you would assume that when you were investing in one of these, either a stock picker or a value fund, you figured you would be making S&P plus a couple of percentage points above that. Let's just say 2-3 percentage points above that. So if the S&P is doing 10, let's say on average 10%, your expectation with one of those guys, and why you'd be paying them, the fees that you're paying them, is that your anticipation would be you'd be making 12-13% annualized returns. Those days really are a struggle now, because really it's index funds or passive investing that has really taken over and is dominating the market. Because of that reason, S&P cash is moving way quicker than I originally anticipated. Now, I will put one caveat in. Markets don't index-based markets do not like gaps. So can the S&P fill this gap first and then go? Yes, 100%. It could. Could it just go straight and then make a new all-time high and then come back and fill the gap? Yeah, it could do anything. I'm not going to sit here and try and guesstimate what I think the S&P is going to do, because it's a fool's game, and it's just not worth it, and it's not worth your time, and I'm not going to insult your intelligence. However, with that being said, the market is pushing up. We went through the stocks so we could see how things are moving. Because of this reason, it goes back to something I've said earlier, not today, but in the past. Trade the market in front of you, not the one you want. You may want it to go down, but if it's not going down, get out of the way. Don't try and enforce it, because you're going to lose. I know it sounds weird saying that, but you are going to lose. There's too much market force out there. You'll just get run over. It's just not worth it. And you could be right, but you could be so early. And in this game, if you're early, you're wrong. So it doesn't matter. So that's what's changed for me. The flows coming into are more powerful than I originally anticipated, which means I have to adapt. That means I have to change, which means you should adapt and you should change. So my outlook has changed because we're getting there faster than I thought. Now, touching upon ES, which is the S&P futures, I'm going to do something separate on them later on. I'm going to just touch upon a basic premise, something to understand. This is my belief. I'm sure I'm going to get a lot of comments about this, but it's fine. I'm a big boy. I don't view S&P or ES or NQ, RTY, YM. To me, they're not speculative assets. To me, they're hedging products. I don't look at them as speculative assets. If anything, to me, they're pure hedging products. What does that mean? So let's say, for example, I made a little cheat sheet here with a check just so we can all see my math. So let's assume for argument's sake, the last time I checked the S&P was 6,010. Okay, let's just assume this is accurate. Okay, it's $50 a point, right? That means the notional value, which means the underlying stock, what it would cost if you had the S&P liquidated, what you would own in stock, is $305,000. Okay, that's how much underlying stock you technically own or you're controlling when you buy one ES contract. Okay, let's say you had $1 billion. You needed to hedge $1 billion in stock. You needed to hedge off, and you wanted to know if I wanted to hedge off dollar for dollar, how many contracts would I need? So let's just do the simple math. I'm going to go 1 billion divided by 305,000 puts you at 3,328 contracts. Now let's just make sure that our math is correct, right? So we're going to go our contracts times the notional. And I have a little check here. Yes. So this is equal to this, so we know our math is correct. Okay? Which means that if you needed to hedge off $1 billion of stock, you could just, if they were, let's say, for example, you were short, you could buy 3,328 contracts and vice versa on the long side. And that's how you're protected, dollar for dollar, if you wanted, okay? Just for the sake of this example. This is what people do. Why do they do it through here and not options and not, they buy puts, they do all kinds of things. Futures offer the benefit of 60-40 from a tax perspective. Again, I'm not going to get into that. You can look that up for yourselves. So it's much easier, and the liquidity is there in the futures markets to just hedge off your portfolio this way. That is why you could see sometimes that you could see a high short interest, etc., or a high long interest if the market's going down, whatever it is. It's hedges. Understand that it's hedges. You're in something that's designed to be a hedge. It's not designed to be a speculative asset. It's hedging. That's what most people are doing when they're coming into the markets. That's what the computer's doing. That's what professional money managers are doing. They're protecting their downside. Okay? Now, I'm going to wrap it up very quickly. With that being said, can we take out new all-time highs before we fill the gap? Yes. Can we fill the gap first and then go? Yes. The point I'm trying to make, and where my mindset changed, and where everyone's mindset should change, is that the power in this move to the upside, and it's not blockbuster, but there's strength to it, and it's showing you that it doesn't want to go down. You would expect that it would have gotten rejected somewhere in the 58. It didn't. You would have expected that when it got to the liberation gap, it would have got rejected and held and fallen back down. It didn't. So because of this reason, you see that the momentum is to the upside. I hope this answers your questions, and I'll see you next week. Take care.